What is up, YouTube? We are back. It's Sunday here. I got a beer in hand. Do not judge me. It's been a stressful week, but also a good week in the market, if you were shorting it, that is. Now, I want to jump on here and talk about the stock market and how it works. I feel that a lot of people probably don't know. I know I didn't when I first started out, so let's get into it. Now, every second, somewhere in the world, someone is obviously buying a stock and someone else is selling that exact same stock. So based off that, who decides what it's really worth? It's you and millions of ordinary people trading every single day. In the next 13 minutes, I'll pull back the curtains and show you exactly how prices are really set, who's moving the entire market, and why a single headline can send a stock flying or crashing in seconds. So stick around, and by the end, you'll see the market the way pros do. Let's start with the single most important idea in the market: price discovery. Sounds complicated at first, but it's really not. It just means this: we have buyers and sellers who are constantly agreeing on a price. Now, this happens every single second of the day. Here's the simple version. You want to buy a stock and you think it's worth $50. The seller, he wants $51. That small gap between what the buyers are willing to pay and what the sellers want, that is called the spread. So when one of you moves, maybe you offer $50.50, boom, that's where the trade happens. That $50.50 instantly becomes the market price, at least for that exact moment. So that price you see on your screen, it isn't some random number. It's the result of thousands of people, thousands of decisions, beliefs, and emotions meeting in real time. Here's an example. Picture yourself outside a concert, right? Fans are shouting offers. Some are desperate to get in. Some just are trying to flip their tickets and make a quick buck. One buyer says $55. The seller counters $57, but they settle on $56. Now that $56 becomes the going rate until the next shout changes everything. The stock market works the same way, except it's in millions of tiny negotiations happening every single second across thousands of companies. Now, the key idea here is that prices move because of pressure. Demand pushes up, supply pulls down, and when buyers rush in, prices rise. When sellers flood the market, they end up falling. It's basically economic playing out in real time. What you need to remember is that there's no secret committee setting prices, not the CEO, not a back room of insiders. It's just billions of micro decisions from people and firms reacting to news, information, things like that. Now, sure, Wall Street and big players like hedge funds, institutions, and market makers, they can nudge prices, and they often do in the short term. They have scale, they have algorithms and speed on their side, and that's why they can do this. But over time, stocks tend to find their level, their real level, what they're really worth. The market eventually does what it wants to do. Next time you check a stock quote, you want to look at the spread, the gap between the buy and the sell prices. A tight spread just means a lot of activity. It's easy to get in, it's easy to trade. A wide one means just fewer participants. Prices can swing really fast. The takeaway here is that prices aren't fixed, right? Truth is, they're just temporary agreements between people. If you understand that and you stop guessing on what a stock should be and start seeing what it's actually worth right now, and you start focusing on the long term, things will look a lot better. So now that we know prices are just agreements between buyers and sellers, and that big players can influence the stock price and things in the short term, where do all these tiny negotiations actually occur? Where do they happen? Where do they take place? That's where you have exchanges. These are digital marketplaces that basically make every trade possible. They match buyers and sellers around the world. Now, two of the biggest in the US are the New York Stock Exchange and the NASDAQ. You want to think of them as giant matchmaking apps that instantly pair buyers and sellers. They don't make decisions themselves. They just execute the decisions, the instructions that we give them. Now, when you place an order, you're telling the market exactly what to do. There are two main types of orders. That is market orders and limit orders. A market order basically means this: I want to buy this stock right now at whatever price it's at. That way it's fast and it's almost always filled. But in a fast moving market, the price can change between clicking buy and execution. And that difference can cost you, but it rarely happens. Now, a limit order is basically saying, hey, I'll buy only at $50 or less. So it's slower, you have a lot more control, If the stock never reaches your price, right, your order just sits there and you never get in. So no surprises there. And here's an example. A tech stock trades at $100. You hit buy with a market order, and by the time it fills, the stock is at $102. That's $2 more than you initially planned to buy it at. Now, with a limit order at $100, you only buy that stock if that hits that price. There's no extra cost, but you probably never get in, or you might never get in. Now, the reason why the price moved so quickly in our example is because of liquidity. Liquidity is basically how easy it is to buy or sell a stock without pushing the price around. High liquidity, that means there's lots of buyers and sellers. You have tight spreads, smooth trades. Your market order will fill close to the price you see. Low liquidity, on the other hand, there's fewer participants, wide spreads, bigger jumps when someone trades a lot. Now, your market order could end up costing you more than expected. So don't just click buy and hope for the best, right? Know the market you're in, know the market you're stepping into. Before trading, you want to peek at the spread and the recent volume. Tight spread plus steady volume just means your trade will probably go through. A wide spread, you want to brace yourself a little bit, maybe not, but you're probably going to pay more than you expected. The takeaway here is that you want to use market orders if speed matters to you, if you want to get in, and limit orders if price control matters to you. You always want to check liquidity first, but honestly, for most trades, it's really not a big deal. You just want to focus on the stocks you believe in and don't sweat the tiny price wiggles. So now that you know how trades happen, exchanges match buyers and sellers, orders get filled, and liquidity keeps things moving. But all those trades are still coming from someone. So who's actually on the other side of the screen? That's where the market participants come in. And depending on who they are, their size, and their time horizon, they can move prices very differently. First, you have retail investors. These are everyday people. That's you and me. Anyone with pretty much a brokerage account. We trade smaller amounts. Many of us invest for retirement, a side income, or just long-term goals, long-term wealth. Our trades are usually tiny compared with the rest of the market participants. Now, that doesn't mean that we don't matter. It just means that our single buy or sell orders rarely move a stock market on its own. But when millions of us are trading together, suddenly the market notices. Kind of like that GameStop shenanigan that was going on a couple years ago. Now, institutional investors are the heavy hitters, right? These are your mutual funds, your pension funds, your hedge funds, and asset managers, right? They move huge sums of money in one trade. And because of their size, they can nudge prices, sometimes a lot. They also have a lot of research teams, data, and tools most of us don't have at our disposal. So when they make a move, markets usually pay attention. Finally, we have market makers. These are the people behind the scenes, the engine that keeps everything running smoothly. Their job is pretty simple, right? They always have buy and sell prices ready so that trades can happen quickly. Now, they profit from the tiny gap between buying and selling prices, the spread, and they make sure both small retail trades and massive institutions orders can happen all without chaos. All right, finally, we have the market makers. These are the people behind the scenes, right? The engine that keeps everything running smoothly. Now, what is their job? So they always have buy and sell prices ready so that trades happen quickly. They profit from the tiny gap between the buying and selling prices, the spread. That's what they're in business for. They make sure both small retail trades and massive institutions orders can all happen without chaos. So you want to think of them as basically like the bartenders of the stock market, right? They keep the drinks flowing, they keep everything going while everyone else just dances. Now, yes, they are also the same folks who can make your life miserable, especially if you're trading things like options, because again, they are in the business of making money. Now, the takeaway here is that retail traders move the market in tiny ripples, right? Institutions like your banks, investors, they can push these prices around with massive trades, massive big block trades. And market makers, they're always hedging to keep things flowing, right? So if you're doing one thing, they're doing the opposite. So knowing your time horizon and being able to stick to your plan and not letting the short-term moves from the big institutions, the big players, or the market makers to throw you off, most of the time, it's just going to help you. At the end of the day, it's just noise you can ignore. So far, we've talked about who's trading, how orders move stocks, but there's another force here that's shaping the markets. I don't know if most people notice, but ETFs and indexes, they don't just follow the market, right? Sometimes they do create broad market momentum. Indexes and ETFs, these are the forces that have pretty much changed how money works, how money moves in the market. An index is just a list, a basket of stocks that represent basically a slice of the market, like the S&P 500. An ETF is tradable. It's a tradable fund that mirrors that index. So if you buy one share of an S&P ETF, you pretty much instantly own all the tiny pieces of hundreds of companies. It's convenient for investors, but it also changes how markets behave. Now, here's why it matters. When you have a lot of money that is flowing into an ETF, the fund itself has to buy all the stocks in that basket. That will push money into many companies all at once. The result is broad momentum. Entire sectors like technology, banking, financials, energy, etc., they can all rise together. Now, not because each company suddenly got better, but because massive money is buying the whole group. Here's an example. Imagine a tech ETF with 50 companies inside. When a lot of money pours in, the fund itself has to buy all 50 stocks. Even the weaker or slower growing companies, they get a boost here just because they're part of that group. Basically, money flows into the whole team, not just the stars of that ETF. ETFs can make a tiny trade ripple into a huge market move. One big inflow and suddenly dozens of stocks are moving together. Even the weaker ones get dragged along. Now, ETFs can turn a small idea into a big market move almost overnight. Now, you've probably heard the news moves markets, right? In reality, a lot of the time it's a lot of money that's flowing into the ETFs first that pushes prices, and the headlines just catch up afterwards. If you want to see how market mechanics turned into life-changing wins, what you want to do is check out a video I have titled "These 5 Stocks Made Millionaires." Link will be in the description here. But the takeaway here is that ETF flows aren't just background noise, right? They're going to pump up average stocks. They're going to move entire sectors. And being able to spot these flows will let you see the momentum before headlines hit. And it's going to give you a smarter way to trade. Remember how ETFs can move entire sectors just because there's a lot of money flowing in and out. And it's not because a single company suddenly got better. The news works in a similar way, but faster and often more unpredictable. Instead of baskets of stocks, it's headlines and sentiment that trigger action. Now, today, things like algorithms, they amplify every reaction. The quick truth here is that news itself doesn't move prices. Reactions do. You have high-frequency trading firms, bots that scan headlines, earning releases, social posts, and even things like satellite images. They tag them as positive, negative, or neutral, and then they trade instantly based off that. By the time humans read the headlines, trades are already executed. That's why things like volatility spikes on big news days happen. Now, not all headlines matter. Major events, earnings surprises, mergers, analyst upgrades, they reliably do move prices, but generic headlines, those are mostly noise, right? Investor sentiment, fear, greed, excitement, it still shapes the market. But technology is the thing that amplifies it. A small panic will snowball quickly because machines will be able to sense that shift and pile in. Now, you want to treat most headlines as background noise. You want to focus on verified, high-impact events and give yourself a short pause and always think before reacting. Now, speed does win in the short term, but discipline will win over the long term. Here's the bottom line. The stock market, it isn't random, right? It is a system. Prices come from constant negotiations between buyers and sellers, and pretty much these exchanges and order types determine exactly how quickly and how cheaply trades can happen. Retail traders, institutions, and market makers, they each play their part in this entire ecosystem. ETFs and indexes flows, they can drive broad momentum, and things like headlines, sentiment, and algorithms, they do create short-term noise. Why this matters, when you understand how the machine works, you stop reacting and you start making decisions, you start making smarter decisions. That way, when you get an order that didn't fill or why a stock jumps after earnings, you understand why. And things like when the market is leaning on emotion rather than fundamentals, you'll be able to see it, especially if you're doing your part of the job, which is due diligence and being able to read financial statements and understand fundamentals. Now, if you made it to the end of this video, I do appreciate you. Do me a favor, hit that like and subscribe button. I'll see you guys on that next one. Cheers.